In 1694, England could not afford the war it was already fighting. The treasury was £750,000 short, and the Crown was running out of time. Then a Scottish merchant named William Paterson proposed something no nation had tried, a bank that could turn government debt into ready cash for war. Investors subscribed £1.2 million in just 12 days. By 1815, that same institution had helped finance over £150 million in military power. No rival empire could match. The secret bank that helped Britain dominate the world started with a nation on the verge of bankruptcy. By the spring of 1694, England's war chest was nearly empty. The Treasury's ledgers showed a deficit of £750,000, an amount that threatened to halt the army in Flanders and leave the Royal Navy unpaid. The usual sources of cash had dried up. Exchequer bills circulated at steep discounts. Goldsmith bankers demanded double-digit interest, and even the new state lotteries, which had raised £1 million, could not cover the mounting costs of war. Merchants, faced with overdue payments and unreliable government paper, grew wary of lending further. The Crown's requests for private subscriptions yielded only scattered sums, often pledged in parish ledgers and rarely enforceable by law. In this climate of near panic, a Scottish trader named William Paterson stepped forward with a radical proposal. Paterson, already known in London's coffeehouses for his ambitious schemes, drafted a pamphlet that called for a joint stock corporation, one that would lend the government a fixed sum in return for exclusive privileges. His plan was simple but unprecedented. Investors would subscribe £1.2 million at 8% interest, and in exchange, the company would gain the right to issue banknotes and a statutory guarantee of repayment. The promise of a perpetual charter, monopoly privileges, and a government-backed annuity attracted a tight-knit group of London's leading merchants and financiers. Among them were the Houblon brothers, Thomas Neal and Richard Haw, men whose reputations in trade and finance gave the scheme credibility. As Parliament debated the proposal, urgency coloured every session. King William III sent urgent letters to the Lords, warning that without immediate funds, the campaign in the Low Countries would collapse. The London Gazette published daily updates on the state of the Treasury, and rumours of a looming default rippled through the city's markets. On July 27, 1694, after weeks of negotiation and political wrangling, the Bank of England received its royal charter. The Act authorised the full £1.2 million subscription, established the bank's governance by a governor, deputy governor, and a court of directors, and granted the exclusive right to issue notes for 11 years. The bank was also required to provide a weekly loan of £50,000 to the Treasury when needed, ensuring a steady flow of cash for the war effort. The subscription list filled in just 12 days. 54 of London's wealthiest merchants pledged sums averaging £20,000 to £30,000 each, while hundreds of smaller investors contributed the rest. The Crown's guarantee that repayment would come from future customs receipts, the so-called sinking fund, offered a measure of security that previous loans had lacked. The new institution's privileges, from limited liability for shareholders to a government-backed monopoly on issuing notes, were designed to attract capital and stabilize public finance. For the first time, the government could count on a permanent, scalable source of credit, grounded not in the whim of private lenders, but in the legal framework of a public corporation. What began as a desperate response to a fiscal emergency would soon become the foundation of Britain's financial revolution. The Bank of England's new charter did more than authorize a loan. It invented a machine for turning private investment into liquid war money. Parliament's Act laid out the mechanism in plain terms. Anyone could subscribe to the bank's capital in exchange for a perpetual annuity, paying 8%, a rate far lower than the 12 to 15% demanded by Goldsmith bankers. This annuity was not a one-off bond, but a permanent claim on government revenue, secured by a statutory charge on future customs and excise. The principal itself would never be repaid. Instead, investors received a steady stream of interest, and their shares could be sold or pledged at any time, creating a marketable security that could circulate well beyond the original subscribers. The real innovation came with the bank's right to issue notes. Backed by the government loan, these banknotes could be exchanged for coin on demand, or used as payment for goods, wages, and contracts. Within a year, the bank had issued notes totaling over £760,000, more than half the original loan, effectively doubling the amount of liquid capital available to the Treasury. Unlike exchequer bills or private IOUs, these notes carried the full faith of both the bank and the Crown. Merchants, shopkeepers, and even army suppliers began accepting them at face value, knowing they could redeem them for gold or silver at the bank's counter. The process worked through a simple but powerful cycle. Subscribers paid in their cash, which the bank advanced to the government. In return, the bank received government securities yielding 8%, and it used these assets to back the issue of its notes. The bank's ledgers tracked every transaction. For every pound of notes in circulation, there was a matching entry in government debt held by the bank. This tight link between public credit and private money created a new confidence in paper currency and gave the government a way to pay troops, suppliers, and creditors without waiting for tax receipts or shipments of coin from abroad. What made the system durable was its liquidity. Investors who needed cash could sell their annuity shares in the bustling coffeehouses of Exchange Alley, where prices responded to supply and demand. Banknotes, meanwhile, flowed rapidly through the economy, easing the Treasury's cash flow at a time when war expenses threatened to outstrip every other source of funding. The bank's weekly advances of £50,000 to the Treasury, as required by the Charter, kept the war effort moving even when tax revenues lagged behind. By the end of 1695, Bank of England notes in circulation had reached nearly £2 million, far surpassing the original subscription and providing a flexible reservoir of cash for both government and commerce. The 8% annuity became the benchmark for government borrowing, gradually replacing the patchwork of high-interest loans and unreliable bills that had plagued English finance for decades. Through this mechanism, the bank transformed the Crown's promise to pay into a new kind of fiscal technology, one that could scale with the demands of war and adapt to the needs of a growing economy. In the summer of 1704, the Duke of Marlborough's army crossed the Danube and struck at the heart of Bavaria. Behind the lines, paymasters in London dispatched Bank of England notes and pay cards to the front, ensuring that soldiers received their wages in full and on time. Marlborough's own dispatch from the field, dated August 13th, records, "The funds supplied by your notes have enabled us to maintain the siege, keep the men in good heart, and secure the necessary stores." The victory at Blenheim owed as much to logistics as to tactics. With the bank's credit underpinning every purchase, quartermasters secured wagons, horses, and powder from suppliers who trusted the new notes as good as coin. War Office maps from the campaign trace a supply line stretching from London's counting houses to the depots at Donauwörth and Hochstädt. The flow of funds did not falter, even as the army marched across hostile territory. In the same year, British forces landed at Gibraltar. The siege that followed lasted for months, but the garrison's pay arrived without delay, a fact noted in Treasury memoranda. The bank's weekly advances kept the Royal Navy supplied with victuals and munitions, allowing the fleet to hold the rock against repeated assaults. By the campaign's end, the Treasury's ledgers showed that nearly £500,000 had been paid out in bank-backed notes, each one a promise honoured by the Crown and trusted by merchants from Portsmouth to Barcelona. These battlefield successes made the power of public credit visible. The bank's machinery turned distant paper obligations into boots, bread, and gunpowder at the front. Without it, the victories at Blenheim and Gibraltar would have remained plans on a map, not events that reshaped the balance of power in Europe. Between 1702 and 1711, the cost of Britain's wars soared to levels that would have been unthinkable a decade earlier. Treasury accounts from this period show a military budget that more than doubled, from £1.3 million at the start of Queen Anne's reign to over £3 million by the end of Marlborough's campaigns. This was not a one-off surge, but a sustained escalation, as Parliament approved ever larger appropriations to keep armies in the field and fleets at sea. The Bank of England's credit machine made this scaling possible. Each year, the Treasury tapped into the bank's reserves, drawing down loans that were repaid through new taxes and a growing national debt. Ledgers from the Exchequer reveal how quickly the sums mounted. In 1706 alone, over £2.2 million passed through the bank's hands on behalf of the government. By 1710, annual interest payments on the national debt had climbed above £600,000, a figure that dwarfed the entire peacetime budget of the previous generation. The ability to raise such vast sums, and to do so reliably year after year, set Britain apart from its rivals. Where France and Spain struggled to fund their armies through forced loans and erratic tax collections, Britain relied on a system that turned public confidence into ready cash. The numbers themselves tell the story. War budgets that once strained at £1 million now exceeded £3 million. Underwritten by a credit system with room to grow, the bank's partnership with the Treasury laid the groundwork for a new model of state finance, one capable of supporting global conflict on an unprecedented scale. Exchange Alley in late 17th century London pulsed with the energy of a market in constant motion. Here, in a tight warren of coffee houses and narrow lanes, brokers jostled for position, calling out prices for Bank of England annuities, Exchequer bills, and the latest government notes. Jonathans and Garraways were the daily haunts of men who lived by the turn of the market, stock jobbers, merchants, and the city's new class of professional brokers. Their minutes, scribbled in ledgers and broker books, recorded the ebb and flow of prices with a precision that rivaled any trading floor. Information moved fast. Lloyd's Coffee House, a few streets away, became the nerve center for news. Each morning, Edward Lloyd posted his famous lists, ship arrivals, insurance rates, and crucially, the going price for government paper. A rumor of a lost convoy or a Treasury payment could move the market in minutes. In this ecosystem, liquidity was not just a feature, it was the lifeblood. Investors from every corner of London, cloth merchants, apothecaries, and retired naval officers could walk into a coffee house and sell their shares or annuity tickets for cash on the spot. Pricing was transparent and competitive. Brokers quoted yields and discounts aloud, while the daily lists published by Lloyd's and the Stockbrokers Society tracked each fluctuation. This open market allowed buyers and sellers to meet at fair value, and the sheer diversity of participants made it possible for even small investors to find a ready market for their holdings. The infrastructure of confidence rested on these venues and the constant flow of information. The ability to liquidate a position quickly, whether a £100 annuity or a £1,000 banknote, meant that investors trusted their money was never locked away. The city's market ecosystem, bustling and noisy as it was, created a deep reservoir of capital that could be tapped by the government at a moment's notice, turning the promise of public credit into tangible, ready cash. Parliament anchored every major British loan with a legal guarantee. Statutes earmarked customs and excise revenues for debt service, and the Consolidated Fund Acts of the early 18th century gave bondholders a direct claim enforced by law. If interest was missed, it wasn't just a broken promise, it was a violation of statute. This system reassured investors that their money was protected by the authority of Parliament, not the whims of a monarch. British creditors could see their rights spelled out in acts and enforced by courts. The Bank of England's ledgers tracked every annuity and coupon paid. If Parliament failed to pay, it faced a constitutional crisis. This legal security meant British government bonds, annuities, exchequer bills, and consols traded at lower yields than any continental rival. In London, a 4% annuity hovered near par. In Paris, French rentes paid 5 to 6%, reflecting the risk of missed payments or outright default. Across the Channel, the picture was starkly different. France relied on tax farming and forced loans, with repayment depending on the king's word. When money ran short, defaults followed. In 1701, Louis XIV suspended interest on war bonds. Another suspension came in 1715. The collapse of John Law's Mississippi Company in 1720 destroyed French public credit. Spain's finances, propped up by American silver and local lenders, proved even shakier. By 1708, The Spanish crown could not meet interest payments, forcing lenders to accept delays or partial repayments. Britain's institutional edge, Parliament's willingness to bind itself to creditors, let it raise money faster, in greater sums and at lower cost, fueling its rise as a financial powerhouse. Britain's financial system, sharpened by decades of reform, reached its apex in the age of Napoleon. The 1751 Act of Consolidation transformed scattered government annuities into the consul, a perpetual bond, easy to trade, offering a steady 3% return. The Bank of England's ledgers tracked every transaction, making public debt transparent and dependable. As war costs mounted, this machinery was tested as never before. By 1815, Britain's funded debt had climbed to £150 million, a sum that eclipsed the national income of most European powers. William Pitt the Younger, determined to meet wartime demands, introduced the first income tax in 1799. Targeting those earning over £60 a year, it brought in at least £10 million annually, feeding the Treasury's insatiable need for funds. Consuls and exchequer bills kept the money flowing, financing campaigns from Spain to the Caribbean. The Royal Navy's triumph at Trafalgar in 1805 was paid for in part by £2.6 million in naval spending, much of it raised through these instruments. London's bond market, built on legal guarantees and a broad tax base, gave Britain a credit power unmatched by France or Spain, fueling armies, fleets, and victory. In 1720, London's financial world was swept up in a frenzy that would leave a deep scar across Britain's new system of public credit. The South Sea Company, granted a monopoly on trade with Spanish America, promised fortunes to anyone willing to buy its shares. Speculative pamphlets circulated in coffee houses, touting endless profits. Within months, the price of South Sea shares soared from £128 to an astonishing £1,000. Brokers, shopkeepers, and aristocrats alike rushed to invest, often borrowing against their homes or businesses to join the boom. But the promise of easy riches could not last. By September, rumors of fraud and overvaluation triggered a panic. Prices crashed back to £150 in weeks. More than £13 million in paper wealth vanished. Thousands of investors were ruined, and the shock rippled through the city's markets. Parliament responded with a formal inquiry. The minutes of the South Sea Committee reveal a world of insider deals and official corruption. Senior ministers had secured privileged share allocations, and company directors had misrepresented the value of overseas trade. The committee's findings led to the seizure of assets and the redistribution of £5 million to those hardest hit. Public anger spilled into pamphlets and debates, with critics denouncing the rentier class for profiting from speculation while ordinary families lost their savings. The Bubble Act of 1722, passed in the wake of the scandal, tried to rein in joint stock companies, but the scars of the crash lingered. The South Sea Bubble exposed the volatility and moral hazards of a system built on confidence, and forced both government and public to reckon with the true costs of financial innovation. Today's national power still relies on the invisible engine of financial trust. Modern states issue trillions in government bonds, with markets watching every move. The system born in London over 300 years ago shapes how nations arm, compete, and survive. The real contest is not just on battlefields. It is fought in the confidence of markets. How secure is the credit backing your future?